Bhargav Dasgupta, the MD and CEO at ICICI Lombard General Insurance, joining in. Bhargav, hi, good morning. Great to have you on the show. Thanks for joining ET Now. I'm just going through your earnings. There's been a recovery on a month-on-month basis as well. And, by the monthly data, July witnessed an uptick in premium collections. Do you see the trend actually hold up, Bhargav? And has August also translated well in terms of premium collections?
First, thank you for having me on your show, and good morning to all your viewers. What we've seen is, if you see month-on-month numbers, April, May, June, July, we are seeing decent improvement across months. April, of course, was really slow. May, was early signs of pickup. But June was a positive month for the industry, and for us, July was even more so. Looking ahead, the trend line gives us some amount of comfort. Having said that, there is one bit of worry that remains, that the sporadic changes that is happening in terms of lockdowns in certain cities at different points in time, that is a cause of concern. So our sense is that it will be strongly correlated to what we see with the virus. And if we finally see some tapering coming through in the next few weeks or thereafter, then we should see a good festive season. For us, the motor, insurance is a large piece. So if we see some stabilization of this pandemic, then we'll see a good festive season. On the other side, and that was on the motor side. On the health, there is generally a consistent improvement that we are seeing. There is some amount of kind of flattening of the demand increase that we were seeing. The demand is still elevated, but we are not seeing the increase in the rate of growth that we were seeing earlier. And that's also probably understandable, because there's some amount of saturation of the numbers that we are seeing at the health side. But overall, yes, the trend looks positive.
Mr. Dasgupta, Nikunj Dalmia also joining in. Good to have you and good to connect with you. It's been a while we've spoken on air. My big picture question is, the insurance industry, the segment which you represent, general insurance industry, has seen a CAGR growth of about 14-15% in last 10 years. Because of this pandemic crisis, could there be a structural change there?
Good connecting with you, Nikunj. And as I said, thank you for having me on your show. In terms of the overall trend line that we see with the medium to long term, of course, this year is a discontinuity. For every industry and for us, it's a discontinuity. And the growth numbers, obviously will not be in line with what we've seen in the past. Having said that, I think general insurance business will still show some amount of growth. Even if it's a single-digit growth for the year, we will have a growth, which itself is quite remarkable in the current context. But if I come back to your question on the more structural changes, we generally believe that there is a huge runway of growth for this industry. There is under-penetration at a level which is, which even if you compare with, let's say, BRICS nations, if you, let's say, compare with China, our insurance density is almost 1/10 Chinese numbers. I'm not even comparing with the Western world. So there is a huge runway of growth. And our sense is that this industry will continue to grow at least 2.5 times real GDP growth for the foreseeable future.
You have a formidable track record, that data which is out there in the public domain, that a PAT growth of more than 20%, much better than the industry. But because of this acquisition, will your historical growth numbers get challenged? Because in Bharti acquisition, it's going to be dilutive. You're taking some crop insurance there. Their OPEX is very high. So obviously, this will be pushing you back.
Look, coming to that deal, there are many factors that we've looked at when we've, considered the scheme that we just announced over the weekend. In terms of our numbers, obviously I can't give you any forward-looking statement, but if you look at our 10-12-year history, and even in a period where, because of de-tarification, the prices dropped tremendously in this period from 2008 onwards, we've had more than 20% CAGR in terms of profit after tax over this 12-year cycle. So there are certain things that we've kind of focused on in terms of being disciplined, in terms of building a sustainable business, and that philosophy doesn't change. Now, when we look at the potential merger, of course, it's subject to all regulatory approvals. There are a huge amount of synergies that we see in the two businesses. We see very high level cultural fit and a good talent base, in Bharti-AXA, which in our mind is a very important factor that at times doesn't get considered in the numbers when you look at integration. And overall high quality governance, and a reputation of the partners, the investors. So all of these factors went into play when we looked at this transaction. Now, if you look at the synergies, there is of course revenue synergy in terms of the distribution outreach that we get. In terms of cost synergy, if you look at Bharti-AXA, there are slightly smaller in size, right? And there is a certain scale disadvantages that you have at that size. And if you look at their operating cost, the expense ratio as we call it, that's about 42%, while for us it is in the 20s, maybe 26-27%, depending upon which you look at. So there is a huge amount of cost synergy that we believe we will see on top of the revenue synergy that I talked about.
That you will now get back into crop insurance, something consciously which you have avoided. Isn't that going to be in baggage?
Look, our view on crop insurance was always driven by the current reinsurance terms and the pricing in the market. Fundamentally and philosophically, we like the crop insurance business because the way the scheme was designed, we always believed it was probably the best architected scheme that we've seen over the last, at least 20 years that we've been in business. And we've been doing crop insurance from 2009 onwards. And these discontinuities also can change some of those dynamics. And if, let's say, the underwriting model, the pricing in the market changes, which we are beginning to see some improvement, and if the reinsurance, market changes, then it could become a viable business again for us. It was, as I said, a call taken given the current reality of the crop insurance at that point in time. Now, in this situation, Bharti-AXA has some commitments, 3-year commitments in terms of crop insurance that they've written. We will obviously honor that. Thereafter, we will study, in terms of the quality of business and the market dynamics at that point in time. And if we believe that it makes sense for both our policyholder and our shareholders to continue, we will continue.
Just when your CD ratio was nearing 100% and you were about to take a giant leap forward, will the pandemic push all those ratios down? I mean, can we assume that whatever plans you had for FY21 because of Corona, everything will be implemented, but it's like everything has got delayed by 3 to 4 quarters? Is my broad assessment right on other ratios like combined ratio, CD ratio and other things?
Look, I can't give you a forward-looking statement on combined ratio, but just to give you a sense that where we are and what we've been driving, our focus has been in terms of, as I said, disciplined underwriting, so that the combined ratio stays around 100 and ultimately deliver a 20% ROE. And that's something you've seen us being able to deliver since the time we've been listed. Going ahead, that objective doesn't change. And we remain reasonably confident in the medium term to be able to continue to deliver that performance.
Sure. Bhargav, I know you've got to run at 9:50, but just an extension to the point that you were making right now, you managed to maintain your market share at 8.5% ex-crop. With the merger, now you're going to be the third largest player. Which are the segments you think are going to be the key growth drivers for you, both in terms of revenues as well as market share going forward?
So if you look at the segmental market share, post this merger on a pro forma basis, one key segment that we've been focused on, and even Bharti-AXA has been very strong in, is motor. And our overall market share moves from 10% to 12% on a pro forma basis. Now, even with a 12% market share, it is not as if, there is no headroom for growth. We continue to believe that motor will continue to do well. Obviously, this year has been a bit of a setback on the motor side, but in the medium to long term, we believe that segment will continue to grow. The second segment that we've been always talking a lot about is the health, and there we are, particularly for new health business, we are seeing rapid growth. And in the distribution franchise that we are, hoping to bring in because of the Bharti-AXA acquisition, we believe there is an opportunity to cross-sell and upsell some of our health products and the new health, initiatives that we are launching. Lastly, our focus remains on SME, corporate, and the digital piece. Those two will continue, and even there, Bharti-AXA has built some initial building blocks in terms of scaling those businesses up, which will be complementary to us.